In this video, we're going to talk about using a time-based stop loss strategy. Stay tuned. Hey traders, a very warm welcome to you. Okay, so several videos I've done. Go and check them out if you haven't already, or they'll be coming up very, very soon if you haven't seen them yet. Talking about stop loss. Now, to me, stop loss is so important. Not only does it cap risk, but it's really going to tell you whether you're going to make money or not. Sounds quite blunt, but it's true. You could have the best strategy in the world, but if your stop is too tight, you're going to get pinged out on the slightest bit of noise. Your stop's too wide, you can't take that much risk. You can't dial up the position size. Sure, you can have a massive wide stop, but you can't have a decent position size because it's going to be a massive amount of risk. So that's why stop losses are so important. Talked about fixed stop. Talked about levels of stop, end day stops, using indicators. Now, one thing which I use very often in day trading, so I'm going to look at it from a day trading perspective, and we'll also look at it from a swing trading perspective, is a time-based stop. So in other words, you take a trade and you say to yourself, if it doesn't do what I want it to do by this time, I am out. Let's have a look at an example on one of my favorite indexes, the DAX, and I'm going to look at a day trading perspective on a 15-minute chart and a strategy that I actually do quite like to trade, and let's talk about it. So I'm going to put a vertical line in here for the open. Okay, so example would be, let's say we are going long at the, this is probably the worst example I've picked, but okay, let's kind of frame it a little bit better. If we said here, there's the high of that period, let's say we're going long on a breakout of that. For argument's sake, whether that's a genuine good trade or not, doesn't matter. So we might just say, okay, that's that, and we've got our stop loss at X ticks below, or below that low there, whatever it may be. We may have a target up here, but we may say to ourselves, hey, listen, you know what? If it doesn't do it within an hour, I'm not going to take it. Now, why would you say that? You'd say that because if you were buying, let's say, a volatility expansion trade, the whole point of a volatility expansion trade or a breakout trade is that you're looking for extra participants to get involved and to push the market in your direction. So if you're buying a breakout early in the morning, for example, you don't really want to be, unless it's part of a longer term strategy, but if you're looking for literally a volatility expansion, spike, breakout, 15-minute burst, and you want to capture that little chunk, you don't want to be in the trade 2 hours later at lunchtime when it's chopping around. It's not the premise of the trade. It's not the point of the trade, and you've got to stick to the premise. So, you know, I might say to myself, hey, listen, if I'm buying that breakout there, it's got to happen pretty quickly. Otherwise, you know, I don't want it, because the whole point of it's not going to happen. It's the same as if you were buying a double top or a double bottom. It's like, listen, if it's going to hang around below the low that I've bought at, I just don't want it. And you know what? You can use this as well with daily charts. And let's look at a currency pair like Euro US dollar. Popular one. I know a lot of you guys out there trade the currencies, in particular the euro. So, for example, let's just say you were maybe my drawing pan out. Let's say you'd kind of sold this double top here. You know, you'd say to yourself, you know what? If it doesn't break down, you know, and start to move in my direction within a couple of days, I don't want it, because you know, you wouldn't want the price to be sort of sitting and just holding at highs. The point, if you're selling that high, is that you think it's rejected. You think the price has rejected the level. If it's hanging around by it, you might want to come out. You might say, you know, listen, even if it doesn't break through my stop, which is going to be above the high, I just don't want it. I don't want to get involved in it. It's not the trade I'm looking for. I'm looking for that rejection straight away, and it has to happen quickly. So it can be on multiple time frames. It can be on kind of multiple strategies. But the trick for you is to say, hey, what's the premise of this trade? You know, is the premise that you know, it has to do what it should do? And also you can put it in kind of a price range as well. Let's say you were selling a breakout to the low side, right? There's your kind of break to the low side. It's congesting here, and you're selling a break to the low side. You know, you can almost, you can say to yourself, hey, listen, you know, if price stays in this level below, I'm happy. And if it stays, you know, it's got to be below that level for longer the next period of time as well. So rather than just saying it's got to do it quickly, you can say, hey, I want to see the price is staying below my key level before I kind of say, yes, you know what, I'm holding this position. Once it's proven itself, perhaps that is a break, it's gone, it's held. In fact, this example just literally jumped out at me right away on this chart here, Euro. Get the brush out. Let's say you bought this breakout here of the high, and it's congesting, and you see it's congesting for multiple days. That's in the flip side is going to give you confidence to say, yes, okay, time-based stop, that's fine, it's done it, it's long, it's holding in a longer period of time, it's accepting that level. I think we're going to go to highs, which is kind of the contradiction of what we started with, which is, hey, if price doesn't break out straight away and do it quickly, you know, I don't want it because it's a volatility expansion trade. It needs to happen quickly. The whole point of it is it's surprising people, it's stopping people out, it's catching people out. And if it's not catching people out, my premise is wrong. Even though it might still go in my direction, I want to stick with the premise of the trade. Same with the rejection of the high or low kind of thing. Push up, wanted to reject straight away and push back down to the other side. Example of that would be, let's go with another currency pair example, US dollar yen. You know, that rejection of the high here, whenever it was, doesn't matter the date. The point is we're selling it there. We want to see it reject. You know, we say to ourselves, hey, it's got to move to my target of 100 pips within 3 days, or I don't want it. That would be a very, very simple time stop. So you take your short 114, you've got your target at 113, and if it doesn't in 3 days' time, if it either hits your target, great. If it doesn't, you close it in 3 days, because whatever reason is, the premise is that the volatility has changed. And that's a really good way of framing the trade, guys. Let me know your thoughts on that. I'd be interested to hear your thoughts on time-based stop. I've used it a lot in my day trading. I can see there's a synergy there with swing trading as well. Useful way of kind of not getting stuck in stuff that you don't want to be. Specifically for day trading, last thing you want is to be trading a breakout and then holding that thing over lunchtime. When it's sitting there, just throwing stuff on my desk. When it's sitting there over lunchtime, the last thing you want is to be sitting there holding that when it's chopping around, when it was initially a real breakout volatility expansion type trade. So take care, guys. See you in the next one. Bye bye.